Our next guest says as the narrative slowly moves away from Fed policy, the market is fairly priced, and that's good news for long-term investors. Joining us now, Julie Biel, Chief Market Strategist and Portfolio Manager at Kayne Anderson Rudnick and a CNBC contributor. Julie, good to see you, and see you earlier in the day. Usually when I see you, I'm on fast money with you, substituting for someone.
That's right.
Good to have you here. Talk us through what's been going on in the market over the past week or so as what had been sort of a string of unbroken gains turns into a little bit more choppy performance, basically on that inflation news, I suppose.
Yeah, I think it's the problem with expectations in life when they're really high, and the stock market is, then we set ourselves up for disappointment. And so the market really got enthusiastic about the number of cuts as opposed to just listening to what the Fed was saying in terms of, we're going to wait until we have more confirmation data that says we can really cut here. And I think all you have to do is look at the dot plot. There are 3 Fed governors right now that say in 2025 their rates are going to be above 5%, and there's one that's at 2.5%, right? So there's a lot of divergence of opinion with the Fed. And I think what that means is we don't really know. They don't really know. It's data dependent, and what you should focus on are, the stocks in your portfolio and owning good quality.
I have this feeling, maybe it's just sort of silliness on my part, but that, the investors have waited for the Fed to start cutting rates. And it's gone from 6 cuts in 2024 to 3 or to 4, whatever it happens to be. But I have this feeling that when the Fed actually does start to cut rates, investors are going to go, oh, well, that's not good news, because that means there are only 2 more cuts coming. You know what I mean? In other words, we've already had one. It's not going to, Christmas isn't going to go on forever. What do you think?
I think that is exactly the right metaphor, as the enthusiasm is more about, the potential for the pivot. And then once we get the pivot, we're not as excited. That's also just like how life works, right? But I think we don't know, right? They really don't know. I think that's really clear as they're trying in all of their body posturing to give themselves the most amount of room to wiggle in each direction or not. What we don't want is for them to be cutting rates because there's trouble in the economy. That's actually super bad for the risk assets that seem to be rallying. And so I think it just kind of bears repeating. You want to protect yourself because there's still a lot of uncertainty in this market.
That's a deep thought about how life works. That when the surprise has actually arrived, you begin to lose a little bit of the juice for the surprise. Let's talk about some of the stocks that seem. An awful lot of stocks. Here's Walmart at an all-time high. There's an Nvidia, just an unbreakable stock until maybe today. What about the stocks that are setting up those records? Are those stocks you can continue to trust, or ones from which you might take profit?
I think you have to look at each of them pretty individually. The way that I look at it is when I have a stock that's had a really big rally, my scope of consideration for it and whether or not I should continue to own it, my skepticism, the bar is just higher on that. And so Nvidia's bar is just super high, but part of that is really founded on goods fundamentals, right? This business has so many big moats around it, and it's so profitable, and its opportunity set looks to be really large. So it makes sense to me owning it. I would be comfortable trimming it here if you had a large gain, right? But it is what I would consider a very high quality business with a lot of strong fundamentals behind it.